Hello, everyone, and welcome to this amazing training. In this program, we're going to be looking at Forex. So we'll start off with introduction to Forex, and during the duration of this course, we'll cover from the beginner level to taking you toward mastery of the Forex market. So we're going to be breaking down, starting off with introduction to Forex. First off, let us put a disclaimer. You need to understand that when trading the financial markets, it does involve some risk. So you want to ensure that you're trading with risk capital, and then this does not serve as investment advice, but as for educational purposes. Who am I? My name is Nnanna Alexander. I am a senior market analyst. I'm a professional trader with about 10 years experience in the market. Do a lot of trainings, in-person trainings, online trainings. I've worked with a number of brokers, GC markets, IV markets, and I am also the CEO of Noah FX Pro and a Forex coach. So I'll be your host throughout this training or this course as we walk you towards going from having little experience or no experience in the market to being a pro trader. So if you're new to the market, if you're new to forex trading, if you found it confusing, you're in the right place. If you do have some experience trading the forex market, then you also want to look at some. If you skip this course and look at some advanced training courses on our program. Okay, so this is what we'll be covering in this course. We'll look at the overview of the forex market, how the forex markets work. We'll look at some basic requirements, what you need to begin trading the forex market. Then we'll look at Japanese candlesticks because we will be looking at technical analysis basically on this course. And then so you need to understand how to read the charts. Look at the foundation of technical analysis, which is support and resistance. We'll look at market cycles and then wrap it up with trend lines and counter trend lines. After this, we'll then proceed to some much advanced analysis and risk management courses. So let's jump right into it. The overview of the forex markets. We're going to try to break down the forex markets, the myths about the forex markets, and for those who are really new, what I found that it's actually quite confusing in some extent to kind of understand the idea or the concepts of buying and selling currencies. So we're going to break that down and use some illustrations to show you how you already do that and how you can profit by doing it more using the online currency trading. So, introduction to forex trading. What exactly is forex? Well, forex is an acronym that stands for foreign exchange. So, it is a market where currencies are exchanged or currencies are traded against each other, just as the name implies. Now, the forex market is unique in that it is the market with the largest trading volume. Still, to put it into perspective, the forex market is the market where more than $6.6 trillion is traded on the market every single trading day. So every single trading day, 6.6 trillion dollars is traded in the market. So this is huge, right? The forex market is a decentralized market that is run electronically. What I mean by that is it is not controlled by any one person, any one government, or any one faction. The market has no central office, and this makes it an autonomous, fully 24-hour a day, 5.5 days a week market. Now, all of these explanations, the main point is the forex market is huge, and the players in the market are global. So everybody in the market is open 24 hours a day for 5.5 days a week. Now, what the forex market is actually what we're doing in forex trading is actually we are simultaneously buying one currency and selling another currency. So, for example, like you see on the screen, you have the euro against the dollar or the pound against the dollar, or stuff like that. We're simultaneously buying one currency and selling another. Now, when we go forward, you'll see how that is the case and how it's not confusing as it may sound. Now let's use an illustration to kind of break down how the forex market works. So let's to make it easy to understand. Let us imagine that we're about to go on a vacation to a different country. So we're preparing to go on a vacation. We want to go and have a good time, maybe by ourselves or maybe with our spouse or our partner. And then we decide that we want to we've decided where we want to go to. So let's say, for example, we want to go to the US or whatever. You need to do certain things. You make your purchase your travel tickets, you make hotel reservations, you need to do all of those things. And very likely you'll be needing to go with cash. So you want to get there and probably be able to buy it, to go places and do some sightseeing. So let's say you decide that you're going to go with $10,000. $10,000 would probably be what you would be going with in order to be able to handle those miscellaneous and sightseeing experiences. Now, in order to, let's say you're going from a country in, let's say, Africa, let's say Nigeria, for example, and the currency that you use would be the naira, for example. Now, you need to change your naira to the dollar. So that means you're going to go to the bank or the bureau to change, and then you're going to have to change your naira to the corresponding dollar, which is what you can spend over there. Now, let's say at the time of your travel, before your travel, you go to the bank to change the money, and the current exchange rate for the dollar is 400 naira to a dollar. So that means in order to buy $10,000, you're going to need to sell 4 million naira. That's the equivalent of 400 times 10,000. So you need 4 million naira to buy $10,000. And so you spend the money, transfer to the transfer, and you receive your $10,000. Now you've gone on your trip. Let's say you've gone on your trip, but let's just assume, for illustration purpose, that when on getting there, you met a very good friend of yours who you've not seen for since primary school or since college, and then this your friend is doing so well. Is now very wealthy and is so excited to see you. Like, "Ah, what are you doing here?" And your friend, then tells you, "Sure, don't worry, I'm going to take care of you. You're going to be my guest. I'm not going to let you spend any single money. I'm going to take care of all your needs." So after having a good time, 2 weeks later, because you met this amazing friend who did not allow you to spend your money, you came back with your $10,000. And when you come back home with your $10,000, remember you have dollars. So you're going to need to change that money to a legal tender of your country. So in this case, we're using Nigeria. And so you're going to need to change back your dollar to the naira. Now you go back to the bank or the beverage chain and you say, okay, so I want to sell dollars, and they ask you how much dollar you need to sell. You tell them $10,000, and they tell you that they are going to buy that the current exchange rate is 450 naira to the dollar. You say, oh, okay, wow. And then you decide, okay, no problem. This here is $10,000, and they transfer you 4.5 million naira. Now, do you notice what just happened? You made a profit of 500,000 simply because you bought the dollar at a certain time, at a certain price when it was lower, and then when you sold it back again, you sold it at a higher price. So you bought low and you sold high. Now, this is exactly what the forex market is. This is just an illustration that you can relate with in order to put it into perspective. What you would notice is that there are two currencies involved. In this case, we have the dollar against the naira. Two currencies are involved, and we are either buying one and selling the other, as we have in the first case, buying the dollar and selling the naira. Or in the second case, we are selling back the dollar and buying back the naira. Right? And so, at the end of the transaction, we made a handsome profit of 500,000. Now, if there is a way you can analyze the market and figure out that a currency pair would appreciate, then you'll be able to look to buy that currency pair against another one. Not so. And this is exactly what we do as forex trader. The objective of forex trading is for us to exchange one currency for another currency with the expectation that price would appreciate in relation to when we bought it and when we sell it back. So this is what we do as traders. The only difference is we don't need to buy physical currencies. We do all our trading or exchanges online, and this is much more easier and much more efficient. And when we go to the advantages of trading forex, you see how it is even much better, because in order to make 500,000 naira here, you need to spend 4 million naira, and it needed to go up by 50 naira, which is quite a lot. The forex market, you don't really need that much, and you can make even much more by using the power of leverage. Now, who are the participants in the market? Well, the forex market is a huge market, and it's played by global market participants. The main participants in the market are the liquidity providers, which are some of the largest banks. Now, we're talking of the banks like the JP Morgans, the Dutch banks, the Citibank, the Barclays Bank, these big banks that more or less determine the exchange rate because they are the liquidity provider. Demand and supply. They handle most of the volume of the daily transaction of the 6.6 trillion daily transaction volume that we talked about. So they handle most of that. The next players in the market is the government and the central banks. And the government and the central banks are key in the market because if you think about it, what we do buying and selling of currencies is simply trading the currencies of countries or zones. And so the governments or the central banks of these zones are always trying to put their currency or their economy in a good position, and this definitely affects the value of their currency. So we pay attention to them because activities that they do, such as cash rates or interest rates, among other things, tends to either strengthen or weaken the economy or their currency. And then as traders, we want to be paying attention to those. Now we also have the smaller banks and the multinationals like the Facebook, the Googles, Teslas, people buying raw materials within countries or within zones. So they need to be able to access the forex market in order to be able to do their business. So they are part of the players in the market. And then we have retail traders and hedge funds and all of those. And these are the lower end of the market. So retail traders includes people like you and me who are trading our personal funds and trading not so much, maybe even 10 million, $1 million in the market, you still so these are all the participants in the market grouped into different sections, and every single section of the market can make profits in the market. Now, why does price fluctuate? Why is it that price move up and down? Why doesn't price stay at a single point? So the simple answer is demand and supply. If you go back to your economics 101, demand and supply tends to, when there's much demand, then the price of a certain commodity goes up. If there's too much supply, the price of that commodity comes down. So the same way, if there's much demand for a particular currency, the value increases. If there's no demand or less demand, the value decreases. If there's too much supply of that currency pair, that's why when countries do what we call qualitative easing, that is when they print new money, it tends to devalue their currency. So because it's going to increase supply. So demand and supply is one of the reasons why price move. And so when traders push towards a currency with higher demand, so when there's a demand for a certain currency or commodity, and more people are trying to get hand on it, it's going to create more demand and lower supply, which is going to then increase the price of the commodity, of the currency, maybe of the cryptocurrency. When there's more demand, then the price would go up. So just like in businesses and sales, the more the demand, the expensive it gets, the less the demand, the cheaper it gets. Now, so things like economic policies, which are implemented by governments, political issues, or even natural disasters, may actually affect the value or the demand of certain currencies or commodity or stake or stock or whatever. So, if there are issues, maybe political issues, governmental policies, or even natural disasters, these things may affect price. So, they may cause demand or excess supply. Now, the forex market hours. The forex market is open 24 hours a day, 5.5 days a week, like I mentioned earlier. And so the market opens from Sunday evening to Friday night. So this is why it's 5.5 days a week. Now, the reason it's a 24-hour a day market is because as one zone is going to bed or is active, the other zone is as one zone is coming away from inactivity, the other zone is going into activity. So just as when you're in one part of of the world and you're awake, you're in the day, some other people are just preparing to go to bed and just like that. So these are the different zones, the major zones and time zones that we look at. So we have the New York session, the London session, the Tokyo session, and the Sydney session. So you can see how there's overlapping between these sessions. So there's an overlapping with New York and the London, between the London and the Tokyo, the Sydney and the Tokyo as well. And this is why the market is a 24-hour a day market. Now, the time of the session in the market with the most volume is actually the New York slash London session. So this zone, especially here between where the New York and the London session overlap, is the session with the most volume in the market, right? And this is one of the periods where the volatility is very much increased in the world financial market. Now let us look at some of the advantages of forex trading. What are the advantages of forex trading? Well, there are a lot of advantages, but I'm going to break them down into four separate fractions. Now, flexibility is the number one. So, the flexibility of the forex market is one of the key advantages of the market. Forex market is open 24 hours a day, like I mentioned, which makes it good. So you can work, you can be a trader, you can trade part time while you keep your daytime job and plan your schedule around the market because the market is open 24 hours a day. There are no restrictions in forex markets. There are no trading restriction whatsoever. You can enter and exit immediately. You can hold positions for longer. You can even trade with any size in the market. So there are no You don't need huge funds to jump into trading the market. And then there are long-term, short-term opportunities. Mid-term, you can make it your part-time source of income. You can make it your full-time. You can become a full-time trader, and then you can become a hybrid more or less. So the flexibility in the market is key. The liquidity is the second advantage I'm going to talk about, and the forex market is the most liquid market, meaning that you instantly you're placing a buy order and you're instantly executed. You're closing your trade and selling back. You're instantly getting back your profit. There are no waiting. There are no time limits. There are no penalties. There are always buyers in the market and there are always sellers. So this is huge. If you think about stock trading, for example, if you're trying to sell a stock, your broker will need to find buyers willing to pay for that stock at that price before the stock to sell. So you might place a trade and order to sell a certain stock, but it might take a long time because they have to find buyers and sellers to process that transaction. That is very, very not very different from the forex market because instantly your trades are executed. There are no waitings, no penalties. Now the size, the you can hold positions for seconds, for minutes, for hours, for days, for months, however it is you wish to trade, you can do that in the forex market. And the simplicity of the forex market is key. You don't need a university degree to start trading the forex market, and you don't need huge equipment to start trading the forex market as well. You need certain basic requirements that we'll discuss later, but listing them here, you need a PC or a mobile phone, you need an internet connection, flexible startup capital, and a reliable broker. So these are key things you need. The size of the market is the next advantage we'll talk about. The daily trading volume in the market is $6.6 trillion. That is huge. So even if you make $10,000 in a day, that doesn't really scratch any surface. So the daily trading volume in the market is huge. That means there's good potential for opportunities. However, you want to be careful that you're trading with proper equity management, right? Proper risk management. While there are good opportunity markets, you want to ensure that you're managing your risk appropriately. Now, let us look at the basic requirements for trading forex. There are four basic requirements, like we mentioned earlier. The first one is going to be, or we'll talk about, is you need a smartphone or you need a PC. So you need a laptop or a desktop, and then you need or a smartphone because the applications for trading you need to install on your PC or your smartphone, and it doesn't require any huge specification, just basic with good RAM, about 4 gig RAM. Just any if it's a laptop, just minimum requirements that is stable. It's okay to trade the market. The next thing you need is internet connection. So you need a good internet connection because you need to connect to your you need to connect to the financial markets, and then you need to do that online. So you need a stable internet connection, not anything extremely outrageous, just a stable internet connection will do. The next thing is going to be startup capital. And then in order to trade the market, you need to start up capital. Now, the good thing about the trading about the first market is with most brokers, you can even start trading with as low as $100, right? So, and with the ability of leverage, you can be able to control more with your little fund. So, it is something that I'm sure we can afford. As far as most brokers are concerned, um, you don't need huge capitals to start trading the forex market. The next thing, which is very important, is you need a reliable broker. Now, you want to trade with a regulated broker that keeps your funds segregated and provides you the latest technology and support to enable you to have a shot at being profitable. So you want to trade with reliable brokers. And some of our partners we currently partner with is IV Markets, Fintech Markets, FXCM. You can trade with these brokers as they are our partners as well. So let's look at the top 8 currencies in the world, the top traded currencies as far as the forex market is concerned. So here are the top traded currencies. You have them euro, the pound, which is GBP, the Australian dollar, the New Zealand dollar, the Japanese yen, the Swiss franc, the Canadian dollar, and last but not least, the US dollar. So the US dollar is the main major currency in the market, and that is why major currency pairs are those pairs that contain the US dollar. So major currency pairs are the top currency pairs that are mixed with the dollar. You have the euro dollar, the pound dollar, the dollar yen, the dollar Swiss, the dollar card, the Aussie dollar, and the New Zealand dollar. That's the Kiwi dollar. These are the major currency pairs. We also have minor currency pairs, which are crosses between the major currencies that do not contain the dollar. So you have Euro, Euro GBP, Euro CHF, and all of these. These are crosses. They all also provide trading opportunities. The difference between these, the major and the crosses, is that most of the times currency pair containing the dollar have much more liquidity or much more, they are much more volume here in markets. Now, making money in the forex market. In business, you make money by buying goods or providing services at a lower price and then selling them at a higher price to make profit. The same is true in the forex market. The only difference is that we're not buying anything physical. Instead, you're buying and selling currencies, looking to profit from the changes in exchange rates. Now, let me explain that. In the forex market, we're not buying anything physical, we're trading the exchange rates of currencies. So we're just trading the exchange rates. A bit where we're looking to buy a certain currency pair and then make profits, such that when we sell back the currency pair, we would make a profit because the price has moved in our favor. You can also make profits buying or selling. That's the beautiful thing about the forex market. You make profits. You can make profits whether price is going up, whether price is coming down. So it's all about figuring out low prices to buy and high prices to sell. It's important to know that successful trading is not about luck. It's a skill set that you can develop and become really good at. And this is what I do for a living. Now, you need to get familiar with some things if you're going to become a forex trader, especially if you're going to be a technical trader. Now, one of the key things, the most important thing you need to know is the PIP, because our entire goal as forex trader is to gain pips, to capture pips. So a pip is the smallest denomination in any currency market. So in any currency pairs, for example, in an exchange rate, it is the smallest, value. Let's put it like the smallest value that we are paying attention to as traders. Now, let me use this to show you an example. So you have the exchange rate of the euro against the dollar, right? The PIP in a non JPY, so any currency pair containing the JPY, that's the Japanese yen, the PIP is slightly different. So in a non JPY pair, the PIP is the fourth decimal place. So you have 1.13215, but this is the PIP, the fourth decimal place, the fourth value after the dot is what is where you start calculating the pips on from. So if it goes up from this that point 1321 to point 1322, it has increased by 1 pip. However, for pairs containing the yen, Japanese yen, the pip goes out at the second decimal place. So 0.21, this is the pip. If it goes up from 0.21 to 0.22, it's increased by 1 pip. So as traders, if we are buying, for example, we want the value to be increasing, and then if we buy at this current price and it goes up from 0.1321 to 0.1331, it has increased by 10 pips, right? If it goes up from 10.21 to 0.31, it has increased by 10 pips as if we're buying. So if we're buying, we make 10 pips. Now, the value of the pip will now be determined by the lot size that we're using. So what is the lot size? This is simply the size of the transaction that we're trading. So the simple what you should pay attention to is this. There are three different types of lot size. So there's a standard lot, there's a mini lot, and there's a micro lot. Now, in a standard lot, what you want to know is the value of 1 pip in a standard lot is $10, approximately $10. The value of 1 pip in a mini lot is $1. The value of 1 pip in a micro lot is 10 cents. So if you capture 10 pips in your trade and you're trading a standard lot, you just made $100 on that trade. If you capture 10 pips and you traded with using the mini lot, you capture $10. You capture 10 pips trading is micro lot, you capture 10 cents. Now the lot size you use will be determined, very likely by the size of your account. So if you have a big account size, then you'd probably be able to trade bigger lot size. So here is the calculation. The profit or loss you make in a trade is equals to the number of pips you capture times the value of your lot size. So if you're buying Euro USD at say this price 1.1950 and you close your position at 1.1970, when you do the math, it's an appreciation of 20 pips. So the profit you make is equals to 20 pips that you captured times the value of your lot size. So if you're trading a standard lot where one pip is equals to $10, then you just made $200 on that trade. If you're trading a mini lot, you just made $20 because the value of the lot is $1. And if you're trading in micro lot, you made $2. Hope we're getting that. Now, this is just a quick explanation of a currency code, right? So you have Euro USD, and this is the value. This is the currency at the front, the one to your left hand side, is what we call the base currency, right? In this case, that's Euro. So the base currency is the currency that determines what we are doing. So if we feel price is going to go up in this currency pair, we will feel the price is going to appreciate, we'll be buying the Euro USD. If we feel the price is going to depreciate, we'll be selling the Euro USD, right? Now, when you're trading the forex market, you usually find that there are two prices. And the reason there are two prices is because one of the prices is the bid price, and the other price is the ask price. So the bid price is the price which you sell, right? The base currency. And the ask price is the price which you buy the base currency in relation to the quote currency. The reason there's a difference is the spread is actually the commission that your broker makes for each trade that you take. So for each trade you take, the broker makes a small spread, which is the difference between the buying price and the selling price, right? So the buying price and the selling price, the difference between that is what we call the spread. I hope we get that point. Now let us. Now, other terminologies that we want to pay attention to that will definitely be will need to get acquainted with is sometimes. So, for example, let's start with the long and short position. So, when you hear long, it's you just your mind should just go to buying, and short, your mind should go to selling. So, when you hear long, you want to think of buying. When you hear short, you want to think of selling. Now, take profit and stop loss is key, very key parameters that you use in your trading. So these are parameters that enable us to not sleep on our charts. So what I mean is, you can take a trade and set your take profit target. That means you can place your trade and go out, close your chart, and then when price gets your target, your take profit level, market will automatically close and give you the profit. The stop loss, on the other hand, is in case you were wrong, you don't want to lose all your capital. If market goes against you up to that level, the broker will execute will close that trade once your stop level is triggered, and instead of losing more, you only lose what you are risking. So this is very essential, and that you need to pay attention to as you place trades. Now, leverage is the ability that your broker offers you to be able to control more money than you actually have. Now, leverage is the reason why you're able to probably trade with $500 account using a 1:100 leverage, because using a 1:100 leverage, it means your $500 or the amount on your account will be treated as if it is 100 times the exact amount. This is one of the good advantages of trading forex. Another term you would also hear a lot is bulls. When you hear bulls, you want to think of buyers. And when you hear bears, you want to think of sellers. Invariably, bullish markets will then mean a market where buyers are in control. That means a market that is ascending, that is going up. And a bearish market will be a market where sellers are in control, and be a market where price is trending lower. A sideways market is a market where price is not really going any higher. It's just moving from side to side, making equal highs and equal lows. And there are two types of markets. You have two types of market analysis so in order to make your decision whether you should buy a currency pair or sell a currency pair, you need to have a bias. You need to have a basics for making your decisions. So there are two ways to analyze the market, and one of them is the fundamental analysis, and the other is technical analysis. Now, fundamental analysis is a way whereby we analyze the markets, we analyze the reason behind price movements by using economic and socio-economic factors. So, fundamental analysis means we're looking at the fundamental reason for why price will move. So, for example, if you look at an economy, the economy is doing fine. If there are signs that the economy will do fine, then it means very likely the currency would be stronger. So, we're looking at the fundamental reasons to make those decisions. So if things like fundamental gauge like trade balance, unemployment rates, retail sales, interest rates, consumer price index, non-farm payrolls, all of these things are fundamental factors that affect currencies, that affects the economy, which in turn affects currencies. So if the news report from a certain government, let's say from the US, is good, then the US dollar is going to likely be strong. So this you can then be looking to buy currency pairs that contain the dollar, buying currency pairs, buying the dollar in currency pairs that contain the dollar. So for example, if you're looking at Euro USD and the dollar is getting stronger, you'll be selling Euro USD, right? If you're looking at USD JPY and the dollar is getting stronger, you'll be buying USD JPY. Now, the other type of analysis that we do is called technical analysis, and this is where we would be doing most focusing most of the time because I am a technical trader. True, I pay attention to the fundamentals, but I make my trading decisions because of technical reasons. So technical analysis is simply what you refer to as chart analysis, whereby we look at price movements and try to analyze what the market will do based on what the market has done. So we are looking at previous price and the repeatable signs in the market in order to predict or market insight to predict the future direction of price because market tends to repeat itself. So as technical traders, we technical traders they use technical strategies like relative strength index, stochastic oscillators, moving average, and all of these beautiful setups. One of the main things we talk about, which I use a lot, is candlestick formation because I feel they are, you want to. I don't use a lot of indicators. I pay attention to the price that is in front of me. So using the candlestick charts and the price patterns, I use this to make off trading decisions. Now, candlesticks. Candlesticks are popular chart patterns, so it's you need to understand the information that they tell you because when you're looking at charts, you'll be seeing a lot of candlesticks. So you need to understand how to what they see. So there are two types of candlesticks: the bullish candlesticks, which shows an appreciation in price, and the bearish candlesticks, which shows a depreciation in price. So in the bullish candlesticks, what you're saying is it shows you each type of candle shows you four key information. First one is they show you the open price. In the bullish candlestick, this is the open price. Then this is the highest price which price went during that period. This is the lowest price which price was during the period. And this is the closing price. So it shows you the open, close, high, and low price. The bearish candlesticks is also show you those key information. The only difference is in this case, price depreciated. It shows you the high, the low, shows you the open price, and it shows you the close price. So let's look at what a candlestick chart will look like. This is a candlestick chart showing you price movements over a period of time. If you look up here, you'll see that this is the JBP, the Great Britain pound against the Japanese yen, and you see something like 1D stands for 1D. So this is the daily chart. So what that means is every candle here represents 1 day of trading. If this was a 1 minute chart, then every candle that you're looking at represents 1 minute of trading. If it was a 1 hour chart, every candle represents 1 hour of trading. So this is the daily chart. Each candle here represents what has transpired between this particular day. So you can see that the price was bearish going down. At some point, the price now became bullish going up. Now, foundation of technical analysis, support and resistance. Now, support and resistance is key, and having a firm understanding of support and resistance is essential if you're going to become a good trader, a profitable trader. You need to understand key levels in the market. Now, support and resistance is key. Successful trading is built on the ability to be able to buy low and sell high. Support and resistance, in my opinion, serves as the basics for figuring out low prices to buy and high prices to sell. Now, now we're doing a lot of slides and all. When we go further in our trainings, we'll be using mostly on the chart. So we'll be working on real life charts, we're working on the chart and looking at price movements, and we'll use less slide. But it's very important that especially if you're new, you have a basic, a good foundation of this thing. So don't worry, when we go to the chart, I'll show you how you can use this and how we'll look at several examples on its application. So if you want to become a successful trader, then you need to figure out how to draw this support and resistance level because as traders, remember, our goal is to buy low and sell high. So if you look at support is think of when you think of support, think of floor. You think of the floor on which you are standing, that would be the support. It's supporting you to stay afloat, to stay above. Now, if you're inside a room, then there's very likely a ceiling above your head. If you were to jump up very high, if you're the best jumper and you can jump, the ceiling would likely be what will resist you from going even further. So the ceiling will serve to bounce back, and the floor will prevent you from going any lower. Right. Now, how does price move? Well, the forex market moves in waves. The market does not move in a straight line, so it doesn't go from point A to point B in a straight line. The market moves in waves, forming repeatable patterns, and this is actually the reason we're able to trade the market. This is the reason we're able to analyze and take advantage of this pattern. Now, support and resistance help us to identify potential areas in the market where we can find going good buying potential or good selling opportunities. Now, let's look at this. Let's look at this illustration of how price moves. So price starts from a low price. If let's say this market is trending, wants to start trending higher. So you see the market does not move in a straight line. What we'll have is the market to move in a wave-like pattern, making higher highs and higher lows. So notice that the market is moving up, down, and this is something you would notice a lot in the markets. The market will not move straight up. It will keep making up, down movement, or down, up movement, down, up movement. So let's say the market is going up, down, you would notice that the market would continue to make this kind of zigzag motions, whether it is going higher or whether it is coming lower. The market would continue to make zigzag motions. Now, what you'd also notice if you pay attention to is that the market tends to respect certain levels, that the market tends to retest certain areas. So once we can figure out those areas, we'll have a good insight as to possible areas where the market would give us potential opportunity. Now look at this. For example, you can see how KSR, there was this area price struggled to get above it, and then when it finally did, you can see how it served as support. So here it was serving as resistance, and then when it went above it, it started serving as support. Eventually, after several periods, you can see how price came back, and that same area served as support. If the price has broken below, you could see it serve as resistance. Now, I know this is just a slide, but this same principle you would see applied on the chart when we go to the chart. Now you can see again this area served as resistance here, served as support here, and again you can see how this area served as resistance, again resistance here, very likely support on this side. Now, successful trading involves buying low. So if you look at this chart, for example, you'd have been able to, if you had bought here, this is a low price, you'd have been able to take some profit. This is a low price, you're able to take some profit. If you were buying from here, you'd very likely either take a loss or have to hold the position for too long. So, but if you were selling from here, you'd have been able to take profit. If you were buying from here, you'd have been able to take profit. So, looking for low prices to buy is essential if you're going to be a profitable trader. Looking for high prices to sell is essential. How to draw support and resistance line correctly. Now, in order to draw support and resistance line correctly, you need to convert your lines. You need to, in my personally, there are a lot of opinions on how you draw them. But personally, I usually prefer to use the line chart. So I convert my charts to the line chart. And then, so it's easy for me to see price movements. Once I do that, the next thing I want to do is to spot areas in the market where there are several touches, where the market gave us several touches, and then use the horizontal line to connect them. So what I'll do now is I'll move over to the chart. I'll look at an example on how to do that. So let's jump over to price chart. Okay, so currently we already have our levels drawn here, but let's pick a different chart. So let's pick a different chart. So let's use something like USD, CHF, for example, and then let us see how price moves.